Let's now turn to more about what's going on with the markets here. And for that, we go to Todd Jablonski. He is Principal Global Asset Allocation Chief Investment Officer. He's joining us from Seattle. And Todd, it's good to see you. And it's interesting because you say we need to sort of reframe how we are thinking about coronavirus, that we shouldn't be thinking about life after COVID, because we don't seem to be seeing through to a life after COVID at this point. It's more life with COVID-19. How do you reframe your thinking then around your investments once you make that sort of mental adjustment?
Well, quite clearly, I think investors are facing a new paradigm, and that's life with COVID-19, not just life, before and after. And what I think that speaks to is, one, having a real understanding of the forces at work affecting the markets, and then two, having an investment playbook that suits that market condition. I mean, the actors are pretty clear. You have the organically functioning global economy. You also have the virus itself and the lockdown measures associated with it. And finally, third, you have a set of policymakers, both at the fiscal and monetary level. Those three agents are acting in unison, Julie, to really inform investors around where to focus on their risks and where to position their portfolios. In our view, life with COVID-19 certainly favors certain asset classes and disfavors others. In particular, we think that the mega cap U.S. equity space, the largest of the technology giants, continue to hold appeal for investors given their business models that are truly tailor-made for a life with COVID-19. On the other hand, you look at some, for example, fixed income categories in treasuries and mortgages and other areas and say there are structural headwinds to these types of investments moving forward.
So what do you see as those, structural headwinds, and how long should an investor be willing to put up with that?
For a pretty limited time. When we talk about structural headwinds in that core fixed income space, what you're looking at is, for balanced investors, why do you own core fixed income? It's usually been to either produce income and to reduce volatility. In those more secure, lower vol spaces, such as treasuries and mortgages, it's hard to project much additional return from lower rates, and monetary stimulus has already happened to a great degree. Those structural challenges really drive investors towards a basket of higher volatility fixed income. And I think that even today, you can look at a basket of investment grade corporates, preferred securities, and the better quality end of the high yield space. And that's an interesting elixir, I think, to generate income and generate returns, all while stability in those asset classes has come to pass, and you're back down to historical levels of risk.
Hey, Todd, Rick Newman here. In terms of the real economy, I think of this as basically two economies. There's the part of the economy that can function more or less normally with COVID, and the other part of the economy that cannot function even close to normal with COVID. So that's obviously restaurants, travel, transportation, and some other things. Markets don't seem to care about the economy that cannot function with COVID. Do you think at some point the collateral damage will bleed into financial markets and markets will have to care about the devastation in that part of the economy?
We've certainly taken some risk off of the table in terms of our equity positionings for that exact reason. A lot of the recovery that you saw in the second quarter, where again, the S&P 500 had its best quarter going back to 1998. A lot of what you saw there was the P in the PE appreciating while the E was depreciating. Again, you saw declining earnings, rising prices. Doesn't take much to understand that's a formula for a higher valued equity market. Fundamentally, you're referring to the service sectors of the economy, indeed, where the pain from the disease itself and the acuteness of the lockdowns and gathering restrictions is most plainly evident in fundamentals. We think that the market's dislocation from the fundamental economy is in many ways fueled by the Federal Reserve and monetary policy that's brought in an incredible amount of monetary stimulus into the marketplace that's giving comfort to investors and allowing continued positioning in risk assets.
Todd, this is Dan Halley. I kind of want to ask kind of a follow on Rick. We've seen the market just kind of out of whack as far as the real economy goes. Still huge numbers of jobless or huge amounts of people who are currently jobless filing for unemployment still. I guess at what point do we start to see the market come back into, alignment with the real economy, if ever?
There are certainly no guarantees around when that happens. I mean, just as stocks typically follow an earnings pattern over the long term, stock markets typically follow economic behavior over the long term. That said, the short term can often lead to very long variances. You can see large dispersions between the level of economic activity and the valuation assigned to those economic enterprises underneath. Today, we don't see necessarily the catalyst in particular to interrupt some of the trends that have been working for investors. For example, the great existential threat to that large cap technology space in the US equity market is regulation. And heretofore, we have yet to see a coordinated, centralized, planned government approach to that. Therefore, with that major risk off the table, many of the forces that have been working, such as, again, mega cap tech, we think portend well into the future.
Todd, you said earlier that because of all of these ideas, you're taking some equity exposure off the table or lowering your equity risk. Where are you putting that? And specifically, I want you to talk about gold for just a sec, just because it's above $1,800 an ounce today. We've seen a lot of investors go in that direction. Do you think that's a good idea? And if not, where else are you looking for safety?
Sure. We've indeed cut a couple of percentage points off of our equity profile, mostly on the basis of the reduced or diminished attractiveness of equities following this tremendous run in the second quarter. It was an easy time to fall your way into double-digit returns in 2Q, though we started to see some of that normalize late in the period. We've taken some of that exposure and shifted it towards higher volatility fixed income, where we think investment-grade corporates, preferreds, and high yield, again, offer that appropriate basket of a lower volatility profile that's suitable to generate the kind of returns investors are seeking. Gold, I think, plays a unique potential in clients' portfolios where you're looking to get a real asset exposure and an inflation sensitivity to beta. That outcome of real return is a space where we've looked at gold, heretofore haven't found it, we think, the right entry point or attractive entry point for that asset class. But we do find that there are other inflation-sensitive asset classes that do have better valuations and entry points today.
All right, Todd, it's good to see you. Good to get some time with you. Todd Jablonski is Principal Global Asset Allocation Chief Investment Officer. Thank you, Todd.